Good morning, everyone. Last class we started with Unit 2. We did Unit 2 is completely related to current asset, and we had done cash and cash equivalent. So today we will start with another current asset, that is trade receivable. Right. So today we will start with trade receivable. Okay. Now, what is trade receivable? First of all, we will understand this. Basically, trade receivable means accounts receivable and bills receivable, right? Now, what is this accounts receivable and bills receivable? So, when I talk about trade receivable, this means accounts receivable, that is amount due from customers on account of credit sale of goods. Right now, whenever I am selling goods on credit, so it's basically a mere acknowledgement of debt. The customer promises to pay. The customer makes an oral promise to pay me a specified sum of money after some period of time, right? So accounts receivable means amount due from customers on account of credit sale of goods. Now, what is this notes receivable? Notes receivable is commonly known as bills receivable. Basically, this is accounts receivable is converted into notes receivable. Now, in this case, in case of accounts receivable, it is an oral promise to pay, that is mere acknowledgement, right? This is mere acknowledgement of debt, and whereas in case of this notes receivable, this is written promise made by customer to pay certain sum of money after certain period of time, right? So there's a difference between accounts receivable and notes receivable. Both comes under trade receivable. Basically, accounts receivable means an oral promise to pay a specified sum of money, and this notes receivable means this accounts receivable is converted into notes receivable by taking written promise, right, from the payer. Okay, so this is mere acknowledgement of debt, right? So last class we spoke about cash and cash equivalent. We have seen that currency, coins, demand deposits, money orders, bank drafts, right, compensating balances, certificate of deposit having a period of holding of less than 3 months, all these comes under cash and cash equivalent. and over there we have seen the concept of restricted cash. If we are keeping, if we are setting aside a certain sum of money for the purchase of property, plant and equipment, then that is restricted cash, and we need to show separately restricted cash from the unrestricted cash. And further, it will depend upon the purpose for which we are setting aside. If it is long term motive, then we need to go show it under non current asset, and if it is for a short motive, then we need to show it under current asset. But whatever may be the case, you need to show it separately from unrestricted cash, right? And then we have seen the concept of bank reconciliation as well, right? So today we are seeing another component of current asset, that is trade receivable. So before going into the valuation of trade receivables and all, first of all, we'd like to know what is trade receivable. So under trade receivable, we have accounts receivable, that is amount due from customers on account of credit sale of goods. It is an oral promise, simply mere acknowledgement of debt. And this note receivable means the receiver directs the payer to pay a certain sum of money after a certain period of time, and it has to be in written, right? So basically it's a written promise made by customer to pay a certain sum of money after a certain period of time. So this is notes receivable, both comes under trade receivable. Now let me just show you journal entry, right? When I talk about journal entries, so simple journal entries. So these journal entries are very simple. Suppose I am doing credit sales. So for credit sales, what will be the entry? It will be accounts receivable debit, sales credit. Very simple. $10,000. Right? Now, when this amount is collected, collection from customer, so it will be cash debit, and then we have accounts receivable credit. Same. This $10,000 will be collected. So these are very simple entries, right? We are making credit sales, and later on we are realizing the amount, right? And in between, if we haven't realized the amount, then this accounts receivable if amount not collected as on year end, then accounts receivable will be shown right. Now if this amount is not yet collected, right, if we haven't collected this amount as of year end, then what we are going to do, if we are unable to collect this amount at year end, then in that case this amount due will be shown as current asset in balance sheet, right? It will be shown as then accounts receivable will be shown in balance sheet as current asset, right? So this is what we have studied in our +2 level. Now let us do some advanced discussion. When you talk about the value of accounts receivable, it has to be at the net realizable value, right? So AR, when I talk about accounts receivable, AR should be shown in balance sheet at the rate NRV, that is adjusted for sales return, allowance for uncollectible debts, discounts, etc. Now, whenever I show this accounts receivable in balance sheet, I have to always keep in mind one thing. I need to show it at NRV, net realizable value, right? And how this net realizable value will be arrived, whatever is the amount due, from that we have to do adjustment for sales return, we have to do adjustment for allowance for uncollectible debts. Suppose if there is a chance, if there is a probability that some portion of this amount won't be received in future, means the customer has filed for bankruptcy and he won't be able to pay the full amount due, then in that case we need to do allowance for those uncollectible debts, right? And similarly we need to keep allowance for discounts as well. So this is very important. So AR should be shown in the balance sheet at NRV, right? It should be adjusted for sales return, allowances for uncollectible debts, discounts, etc. Right? So these things you have to remember. Okay. So now let us talk about one adjustment at a time, right? So initially we'll be talking about this discount, okay? We'll be talking about cash discount, right? Now, when I talk about cash discount, right, we need to understand the discount policy first. Discount policy. Suppose it is written 2/10 net 30. Many write it as like this 2/10 comma n/30. Now what does it mean? If you have a discount policy, something sort of this, then it means that this net 30 means the normal collection period. Normal credit period allowed to customer is 30 days. But pays within 10 days, then 2% discount normal credit period allowed to customer is 30 days, but if customer pays within 10 days, then 2% discount will be given, right? So a discount policy of 2/10 net 30 means the normal collection period is 30 days, and if customer pays within 10 days, then 2% discount will be given. So we need to adjust our trade receivables for the cash discount. So basically there are two methods for it, right? One is the gross method, right? We are assuming that the customer won't be availing the discount, right? So under the gross method, we are assuming that customer would not be availing discount offer, right? This is the gross method. So when we talk about the gross method, so what entry we are going to do for credit sales so it is accounts receivable debit sales credit. So this is $10,000. This is $10,000, right? So here we are assuming that the customers would not be availing right. Now, since you are following gross method, there might be a case that customers might pay you within 10 days. At the very first outset, you need to make an assumption whether he will avail discount or he will not avail discount. So we have assumed that he won't be availing discount offer. But if customer pays within 10 days, then what we are going to do? We haven't shown the discount, right? So in that case, we would be receiving cash how much? We would be receiving cash after 2% discount, that is $9,800, right? So we will write sale discount taken debit, that is cash discount, right? And then we will be writing accounts receivable credit $10,000, and what if payment is not received within discount period? If payment is not received within discount period, it means that payment is received in normal time period, right? So in that case, this is very simple. Cash debit, accounts receivable credit. This is $10,000. Now this discount is given, you can easily see. Now many might have a question that these things are very easy, you have done it in plus 2 level, that this is given for prompt realization of cash, right? This type of discount is given so that you can avail money as quick as possible. Even the discount policy tells you about this particular offer, that normal credit period is 30 days. Normal credit period is 30 days, but if I pay within 10 days, then 2% will be given to the customers. For me, it's an expense, right? So anyway, I am assuming that the customers won't be availing discount offer. So in that case, I have recorded sales at gross figure. But if later on customer avails, then again I'm going to show expense for it, right? So this is about the gross method. Now if I talk about net method, so we are assuming that the customers would be availing discount offer, right? If customers would like to avail the discount offer, then in that case, for this credit sales, we are going to show at the time of credit sales only we are going to show the discount taken, right? When we record the sales, we record it at net value. So this is dollar 9,800. This is dollar 9,000. We will show it at net figure, right? Because I'm assuming that the customers would be availing discount. So if customers would be availing discount, it means I'm going to collect 9,800 only. So the sales will be recorded at 9,800 only. Now if customer is paying, so it is very simple. So cash debit, then we have accounts receivable credit. Anyway, we would be receiving this. Now since I have shown discount, but the customers won't be availing it because they are not paying it within the discount period. So in that case, cash I am going to get full 10,000. I am not going to leave any single penny. But AR in my books stands at 9,800. And I will increase sales discount not taken. I can write discount not taken. Right. So this is very simple. Uh, Trade receivable will be shown in the balance sheet if amount is not yet collected at NRV. It means we need to do adjustment for sales return, discount, and allowance for uncollectible debts, right? If on balance sheet date you have any probability that some portion of the debtor won't be collected or customers has filed for bankruptcy, then it's a clear cut indication that a portion of the debtor will not be realized. So you need to create allowance for that. So we started with cash discount, right? So this is the cash discount offer uh, given to the customer for prompt realization of cash. So there are two methods for it, either the gross method or the net method. Under the gross method, we show sales at gross figure, whereas under net method, we show sales net of discount. Similarly, in here, accounts receivable is shown net of discount, right? This is net of discount. And out here, it is at gross figure. Here it is gross figure. Okay. So now if customer is paying, if under gross method, if customer is paying within 10 days, so anyway we need to irrespective of the fact that whether you are following gross method or net method, customer can select anyone, right? So it is not like that you have to tell me at the very first outset. For doing accounting entry, I need to assume which one I would go for. I would go for gross method or net method. But customer can select till the 10th day, right? It is not like that you have to select you have to tell me today whether you want to go for discount scheme or not. No, it is open for the first 10 days. So even if you do gross method, net method, irrespective of the method of accounting you are following, customer can select any scheme today or tomorrow, right? So I am doing accounting as per gross method. It means I have recorded sales at gross figure. Now if customer is availing the discount, it means customer would be paying us less, so we are going to show discount, right? Expense. This is expense. This is expense, right? Now if the customer is not availing discount, so customer is paying in normal credit rate, so full amount will be realized. Okay. Now under net method, since I have recorded AR at net, if money is collected within discount, no problem. But if money is not collected within discount period, then in that case we are going to collect more. And since we have recorded sales at net of discount, so we can't increase sales again. We can't increase sales again. So what are we going to do here? We are going to create an income, extra income out here. Sales we cannot credit again and again. We can simply create an extra income for the discount not taken, because I have recorded sales at net figure, but now I am going to receive more. Right? Okay. Now there is one concept of trade discount also. So if trade discount and cash discount is given together, then what are we going to do for trade discount? This is given for boosting sales, right? For bulk quantity dealings, whatever, they will give you list price. List price, suppose it is $10,000, and TD is 10%, CD is 5%. Now here we have seen the gross method and net method of accounting, that is for cash discount, right? What about for trade discount, right? Trade discount is never ever shown in books of accounts. It is not even shown in books of accounts. So what are we going to do for trade discount? This is very simple. So list price is less trade discount is minus 1,000. So we are left with 9,000. Then we have cash discount minus 450. Right? So what is the journal entry we are going to do? If I'm talking about the gross method, see, trade discount you did not have to avail the event, you did not have to avail, right? Unlike cash discount. Cash discount is like if you pay within certain period of time, then only you get. But in case of trade discount, you don't have to avail it. The person itself is giving you, right? So anyway, this is my gross figure. This figure is my gross figure, right? So if I am doing accounting as per gross method, then this is accounts receivable debit, sales credit, gross method, I repeat. So this is $9,000, $9,000. Simple. Right? And if not availed, then simply cash debit, so this 9,000 is the gross figure. Now if I talk about the net method, I am recording it at net of discount. So I will collect net of discount within discount period. But in this case, I will collect 9,000. This is 8,550. 450 I will collect extra. So the treatment of trade discount is simply subtract from the list price. That's it. So this method of accounting of discount applies only to cash discount. It does not apply to trade discount. because trade discount you don't have to avail. By default, you are getting it. The seller is providing to the purchaser. Right? So this is the gross figure. Okay. Now, I've already told you that trade receivable should be shown in the balance sheet at net realizable value, right? So, in case of discount, I have already told you, it depends upon whether you follow gross method or whether you follow net method, right? So basically, we are talking about now uncollectible accounts receivable, uh, commonly known as allowance for bad debts. Now, there are two methods. One is the allowance method, another one is the direct method. Now, at the very first class of financial accounting and reporting for this CPA course, I have already told you that whenever we draft any accounts, we need to draft it as per GAAP, General Accepted Accounting Principles, followed in US, uh, right? For the US entities, right? So one is the direct write-off method, but this is not as per GAAP, right? And under this method we do not create any provisions, right? Now, before going into this uncollectible accounts receivable, let me just show you how does an accounts receivable look like, right? If I talk about, right, this is debit, this is credit. So we have beginning balance, right? We have credit sales, because on account of credit sale accounts receivable is increasing. Now, because of collection it will decrease. When it is converted into written promise, then also it will decrease. Mm, We had bad debts, then also it will decrease. So ultimately we will get the closing balance. So this is how a T account for AR looks like. Right? This is increase in AR, and this is decrease in AR. Right? This is the opening balance we had at the beginning of the year, and this much sales we have done. So accounts is receivable has increased, and this is the collection. Then some accounts receivable is converted into trade receivable. Sorry, bills receivable means notes receivable, and few have turned to be bad, means not recoverable, uncollectible debts. 40 मीटर. Okay. Now, first method is direct write-off method, and I tell you again and again, this is non-GAAP. This accounting intent is not followed as per GAAP. Right? Now, this T format of accounts receivable we have learned in our +2 level, right? And this is very simple. This direct write-off method, this is non-GAAP, right? Um, bad debt is recognized when accounts receivable becomes uncollectible. Right? This method is non-GAAP method, as it does not properly match bad debt expenses with sales. This is the biggest problem. Uh, as per matching principle, I had already told you, if you see matching principle, what is this matching principle? Let me just show you small example of matching principle. Matching principle says all expenses are to be matched with revenue of the year, right? Suppose is a sales of 800 units at the rate 50. Now this is revenue, less expenses we would be doing. Now when we are subtracting expenses, the very first expense is purchases, that is 1000 units at the rate 20. But remember one thing, here I am not going to take 20,000, only those number of units will be taken which has been sold, right? All expenses, this is expense, it should be matched with the revenue of the year. So we have purchased 1000 units, but ultimately we have sold 800. So when I talk about this revenue, which is nothing but cost of sales, I will take only 16,000. That is 800 into 20. Commission at the rate 5 per unit. So you all know that commission I will take only 4,000. For 800 into 5. Similarly, rent per month is 500 per month. So when I talk about rent expense, I shall take it for 12 months. Now this is not directly related with the volume. So it has to be relation with the time, right? Because it is clearly written revenue of the year. If matching is with volume, then we do with volume. Like purchase matching is directly with volume. Commission matching is directly with volume. But if it does not match with volume, then it has to be for the year. So rent I am going to take 6,000. Right? Furniture 10,000. Life 5 years. So this particular asset I will use for 5 years. I will derive its benefit for 5 years. So what does the matching principle says? You will take depreciation only for 1 year. 10,000 by 5. So all these expenses are matched with the revenue of the year. Whatever expense we are showing, either it is related with volume or it is related with time. So this is related with volume. This is related with volume. This is related with time. This is related with time. right? Similarly, bad debt expense should also be matched. Similarly, we need to match the bad debt expense also. So if I am following direct write-off method, so whatever bad debt I am showing here, that may not be related with my current year revenue. It might be related to some past debts. So this particular method is non-GAAP, right? As it does not properly match bad debt expenses with the revenue, right? You want to have a look? Just have a look. Like uh, these expenses bad debt expenses should be should also be matched with current year revenue. It should be shown as a percentage of sales. GL. Okay. This method is followed for income tax purpose, right? Income tax only consider those expenses which are actually been incurred, or the losses which the organization has actually suffered. No provision is considered as an expense for income tax or federal tax purpose, right? So this method is followed for income tax purpose. Under this method, no attempt is made in estimating the amount of uncollectible debts included in accounts receivable. Under this method, accounts receivable is overstated. इस मेथड में अपना अकाउंट्स रिसीवेबल ओवरस्टेटेड रहता है, राइट? सो income tax department always considers the write off method. Income tax department does not follow the allowance method, right? So whenever the amount actually becomes bad, that is being considered by the income tax department, right? So direct write off method, it's a non-GAAP method first of all, right? It ignores matching principle, whereas like other expenses, bad debt expense should also be matched with the revenue for the year, right? So under this method, no such provision is created. No allowance for uncollectible debt is created, right? So let me just show you one example. Year 1, credit sales of $10,000. Year 2,
Hello, hello, hello. Hello, 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 hello. Hello. Hello, 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 hello.
accounts receivable was uncollectible and written off. Solution. So what is the journal entry we will do in year 1? Year 1, it will be accounts receivable debit, sales credit, right?
Hello, hello, hello. Wow.
This is $10,000. Okay.
My friend का है.
So we have made a sale of 10,000, right? Fine enough. Uh, if I talk about balance sheet year 1, so under current asset,
Hello, hello, hello. अभी भी
they will
बात
show
नहीं है.
this
Hello, hello, hello,
credit
hello.
receivable,
Hello, 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 hello.
right? So this revenue is shown in year 1.
Hello, 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 hello.
But what are we going to do? In year 2, I'm going to show this bad debt. So we can easily see that revenue is recorded in year 1, but bad debt expense is recorded in year 2. Matching principle not followed. So this is the problem. Right. So this is direct write-off method. It is followed for income tax purpose, right? But we cannot do this type of treatment because we need to draft accounts as per US GAAP. So what treatment we can do? We have to go for allowance method. Number 2, allowance method. This is as per GAAP. Right. Now, whenever you are making a credit sale and then after that you will be uh, evaluating the collection probability, right? Whether the collection is probable or not. So you need to estimate the amount of uncollectible debts, if any, right? There is no such prescribed methodology through which you are going to estimate, okay, this is the if I talk about banking companies, right? Banking companies give loans, right? These are loans and advances given by the banking companies. In India, when bank gives loans to customers, then customers have to pay the principal and the interest on various due dates, right? That those are EMI, easy monthly installment schemes, and there are different dates. On that date, you have to pay the principal and interest as well. Now if customer fails to pay, right, then such loans and advances is being considered doubtful, right? Now if you are paying, if you are paying regularly, fine enough. If you are paying principal interest on time, every month, every quarter, every half, whatever is the case maybe, and if you are paying it on time, then there is no such problem. Right? If you are paying the interest and the principal on time, then your loans and advances will be regarded as performing, and nothing needs to be done as such, right? But if what happens if you fail to pay, then in that case the loans and advances which the banking company has given to the customers will be considered doubtful. And in India, you know that all the banking regulations, the rules, the has been prescribed by the Reserve Bank of India, right? RBI. So RBI time to time formulates the policies, the rules, the regulations for these banking companies, and you have Banking Regulation Act as well. So as per RBI guidelines, as per RBI norms, whenever any loans and advances is being put into doubtful category, then you need to check for how much time it is in doubtful category, for how long it has been in doubtful category. If it is in doubtful for 1 year, or it is in doubtful for 2 years, it is in doubtful for 3 years, right? So accordingly you need to calculate the provision for uncollectible loans and advances, right? So over there's a prescribed norms given by RBI, the Banking Regulation Act, and accordingly you are calculating accordingly you are estimating the amount of uncollectible debts. But in normal cases, in normal companies, right, apart from the person those are engaged in the business of banking, what about other categories of person? There is no such prescribed methodology of estimating the amount of uncollectible debts. So how we are going to estimate the amount of uncollectible debts? We are going to see the history, right? What was the percentage of bad debt in the past, right? So accordingly we are going to get some rates, and on the basis of that we are going to estimate the amount of uncollectible debts, right, in on today's sale and future sales as well, right? So what is this allowance method is all about? Basically estimating the amount of uncollectible debts, uh, estimating the amount of on the basis of historical loss rates, right? And then provision is created for such losses as per prudence principle, right? So we are going to estimate the amount of uncollectible debts on the basis of some historical loss rates, and then provision is created for such losses as per prudence principle. Now the rate of provision can be either based on number A as a percentage of sales during the year, or so these are the two ways you can estimate. Either you can estimate as a percentage of sales, okay fine, sales ka 10%, sales ka 1%, 2% is bad debt expense, right? Or whatever is your closing accounts receivable, because these are the numbers, these are the customers who will pay in you in future. So out of these customers only you can have uncollectible debts. You cannot have uncollectible debts from customers, those who have already paid you. So you are going to have uncollectible debts of these accounts receivable, right, in future. So you are going to estimate that loss today as per prudence, and this is fully gap compliant, right? Because whatever provision we are estimating, we are reducing our current year expenses, right? So the amount of provision created is charged to income statement charged to income statement which matches with the and current year revenue is reduced. Therefore, matching principle is complied with. This is very important. Whatever provision we are creating, the current year revenue is reduced, and therefore matching principle is complied with. Right? So this allowance for uncollectible debts is a contra account for accounts receivable. So the journal entry for allowance for bad debt. अलाउंस फॉर बैड डेप्ट का मतलब ही हो गया अलाउंस फॉर अनकलेक्टिबल डेप्ट्स. सो bad debt expense debit allowance for bad debts credit. Now earlier under direct method, what was the scenario? Let me just show you. Under direct method, you can easily see that straight away the accounts receivable is being reduced only when it has become bad. Accounts receivable is directly reduced only when it becomes bad, uncollectible. But here what is happening? out here what is happening? In our case, it is not yet bad, but still I am showing it as an expense, right? I have booked expenses. I have set aside profit, because this bad debt expense, due to this bad debt expense, my profit will reduce. Due to this bad debt expense, my profit will reduce. My profit will reduce, right? This is charge to income statement. This is charge to income statement. And you can see that I haven't reduced my accounts receivable. But in balance sheet, it will be shown like this. It is simply a contra account, nothing else. So this is AR at the rate NRV. This is AR at the rate NRV. So out here, two things are happening. Under direct method, you can easily see this trade receivable was overstated. I know in this trade receivable there is some uncollectible debt, but I haven't created any allowance for it, because till now it has not become bad. Next year I am showing it as bad debt. Number one, it is not GAAP complied because there is no matching. Revenue I have shown in some year, expense related to that I am showing in some year. Further out here, AR is directly reduced when it becomes bad. If you sell goods today, and this year itself it becomes bad, right? Then it is bad for you but good for accounts. Today you have sold and tomorrow it is becoming bad. It is bad for you but it is good because matching principle. You showed revenue current year and this year itself you are showing expenses, right? See, accounts mein you need to note one thing. You cannot just mug up and go to the exam, right? When you are doing financial accounting and reporting, it has to be 100% conceptual. You need to learn each and every concept, right? So this is direct method. ये आपका direct method है, right? This is direct method. So first of all, you are showing bad when it is becoming uncollectible. When it is already declared bad, then only you are showing. So I am showing revenue in some year, bad debt expense in some year. So anyway, this is not GAAP complied. Matching principle is not fault. But under allowance method, you can see very carefully, I have shown the bad debt expense on some estimation, right? So anyway, on actual basis, when it actually becomes uncollectible, there might be few plus and minus here and there, but some matching has been done. I have shown some part of the expense, right? I have shown some part of the expense, no problem. I have shown some part of the expense. And by creating this allowance, I am subtracting it from accounts receivable. So somehow I am not overstating it. right? Now, when next year actual bad debt happens. So what is happening? I have already created an allowance. Now I am not going to show again bad debt expense. So what I will do, allowance for bad debt debit, and I will reduce my accounts receivable. Right? So now you can see that today it became bad, today it became bad, right? Today it became bad. No problem. I have already shown it in last year. I have already shown last year. So today it became bad. I have already shown last year, means matching is already done. Now when it is becoming bad, I will reduce the allowance which I created last year. It means this provision will be used. See, I'm setting aside profit. What does it mean? What does it mean? What does it mean? Profit set aside for future losses, right? Using up set aside profits for actual losses. So here I am setting aside, but here I am actually using up. Right? No charge to no charge to income statement on actual bad debt, because already last year I have shown matching. Okay. So we do few practical problems next class, right? For this allowance method, right? Because we need to learn how to create a provision when it is given as a percentage of sale, and how to deal when it is given as a percentage of accounts receivable. The concept I have explained you, right? We simply estimate the amount of losses and we create a contra account valuation for this allowance of for this future loss, right, by crediting allowance for bad debt. And when bad debt actually happens, in that case we are not going to again charge our income statement, right? We are going to use up this allowance, right? Okay, so next class we'll be dealing with some practical problems. Okay, bye.